Good morning and welcome to Stock Market Today. It's Thursday, January 30th, 2020, and I am your host, Dan Russo, the Chief Market Strategist at Shaken Analytics. You can find me on Twitter. I'm at Dan_Russo_CMT. Stock Market Today brought to you today and every day by Shaken Analytics. Head over to shakenanalytics.com/today. Sign up for a free email where we get a lot of the content for this show, as well as give you daily stock ideas to consider. Hits your inbox every trading day before the market opens. So it's good to be back after 3 days down at the Inside ETFs conference. So let's get right into it. U.S. equities were mixed on Wednesday after a turnaround Tuesday rally. Industrials and materials led, while energy and REITs underperformed. Treasuries were stronger, with the curve flattening. Definite flight to safety as fears around the coronavirus remain elevated. The dollar was stronger against the euro and pound, but slightly weaker against the yen. Gold was flat, and WTI crude closed down 30 basis points on the day. Now, as we get to the desk this morning, futures are under pressure, down about 70 to 80 basis points in early trading. Asian markets were weaker overnight, with Japan, Hong Kong, and South Korea all down more than 1%, and Taiwan down nearly 6%. China's markets remain closed for the Chinese New Year holiday. European markets are weaker, and treasuries are stronger across the curve. The dollar is weaker on the major crosses. Gold is up 50 basis points, and WTI continues under pressure, down 1.7% to get us going on a Thursday morning. And as we look at the structure of the S&P 500, we haven't been here for a little while, so let's see. We're testing support after fading from the highs. That near-term support zone that we've been highlighting between 3,200 and 3,250 is now being tested. I think it's safe to say we can carve out a little bit of near upside resistance in the 3,300 to 3,330 range for now. What's interesting to me so far, and this may come under pressure today, but the RSI is holding bullish ranges for now. Notice that as the market has pulled back, the RSI has dropped, but it's holding within bullish ranges, and at the same time, Chaikin money flow is bullish. So I think we want to see how it plays out here. Ideally, we'd love to see this support zone between 3,200 and 3,250 hold, with the RSI holding in bullish ranges, and that would be a sign that the market is likely to continue to hold. As always, we want to remain dynamic. We want to manage risk. But for now, we are seeing support hold, and we're not seeing the types of momentum breakdowns that would cause us to get overly concerned. Now, again, futures are under pressure this morning. Let's monitor trading today. I think the way to do it is kind of continue to identify leading stocks and leading areas of the market, but just realize that we've introduced a level of volatility here. We want to manage risk, and we want to become really selective with the ideas on the long side of the portfolio. So taking a look at our market in a minute, what are we writing about in our note to Chaikin Analytics clients? Well, we touched on the mixed session as investors remain really focused on coronavirus. Breadth metrics weaken as the near-term trend has become choppy. Virus fears are also impacting global markets. I see a pullback in software as a potential opportunity. And as I did say, futures do point to a lower open here today. Now, taking a look at the power bars for the major indices, the Dow was flat yesterday, 8 bulls to 6 bears there. S&P 500 down fractionally, 132 to 81 bulls to bears on that market. The NASDAQ outperformed, up 13 basis points yesterday, 32 to 12 bulls to bears in that camp. Small caps were an underperformer. 495 to 277 bulls to bears on the power bar ratio. Bonds, flight to safety bid up nearly 1%, sending yields lower. And according to the Chaikin power bar, small cap stocks and large cap stocks are somewhat bullish. The major markets across the board, however, are mixed. Now, let's take a look at our stock of the day. Remember, the stock of the day is auto-generated based on the power gauge rating, and then I analyze it here for you in real time, as if you came to me and said, hey, Dan, what do you think of CVS Corp? Well, CVS closed at 70.55 yesterday, down 1.77%. Its power gauge rating is very bullish due to very attractive financial metrics, very strong earnings performance. Stock does have some weak price volume activity of late, but when we roll up the 20 factors, 5 in each of these 4 categories, we come out with that very bullish rating. We do have a stock that's in a strong trend, as it's holding the rising long-term trend line, and the healthcare provider industry has been strong. What I'm seeing here, however, though, on this pullback is a deterioration in relative strength. Now, we have that very bullish rating, but we're starting to underperform the broader market. Chaikin money flow is bullish. Stock is getting towards an oversold condition. I However, I think that with the choppiness in the market, a lot of the volatility that we're seeing, a lot of knee jerk reactions, I think you want to wait for better setups. When I say you want to become more selective with your ideas on the bullish side of the portfolio, this is what I'm talking about. CVS is a name that looks compelling, but I don't like that deterioration in relative strength. What I would love to do is continue to monitor CVS and see if that relative strength begins to improve. And then it becomes a little more compelling. It'd be nice to see this $68 to $70 support level hold. I think for now, we want to add CVS to a bullish watch list and monitor that relative strength situation very, very closely. If we start to perk up outperformance and then all else being equal, then it becomes more compelling to me. Now, this is a name that we have liked, and we've kind of come off that a bit. I think you just want to wait for a little bit of a better setup. This breakdown in relative strength is not that compelling to me. I'm going to add CVS to a bullish watch list here today, but I don't feel compelled to really get involved on the long side just yet. Turning now to our sector tracker, looking at the movement of the major sectors over the last 5 days. Uh, you can see the defensive feel, right? Part of it is defensive rotation. Part of it is, and well, kind of goes hand in hand, the decline in rates of investors has bid up treasuries. That has pushed utilities and real estate to the top of the sector list over the last 5 days. And they are the only two groups that are higher over the past 5 trading days. Now, industrials and tech are, flat to down slightly. Staples, materials, discretionary, middle of the road. Financials, comps, healthcare, and energy towards the bottom of the list. So when we're kind of thinking about investor positioning and sector rotation, there's a definite near-term bid to the safety areas of the market, to the bond proxy areas. Energy just continues to deteriorate. Uh, you know, just there's not a lot to say there. The relative performance is poor. The fundamentals based on the Chaikin Power Gauge ratings for the stocks within that sector continue to remain poor as well. And I think what we're starting to see here is fears about a global growth slowdown as it relates or as a function of the possible spreading of this coronavirus that's going to impact the energy complex. It's obviously impacting the price of crude oil here in the near term. Just continue to want to avoid the energy sector. Now, our industry in focus today is another example of how trends change and we want to be adaptive. It's bank services, which over the past 6 months has underperformed the S&P 500 by a little over 4%. Now, it does have a bullish power bar ratio, 20 bulls to 8 bears there, and it's ranked number 9 of 21 subsectors. It has moved down 2 slots over the past week, however. So some of the names in there with very bullish ratings: Umpqua Holdings, UMPQ, East West Bancorp, EWBC, and First Horizon, FHN. As I said, all with very bullish Chaikin Power Gauge ratings. But take a look at the group in general. We're starting to see a breakdown in relative strength. KBE is the ETF that we're looking at here. It has a neutral rating. The Power Gauge ETF rating for KBE is neutral, and the trend has become weak as the fund has dropped below the long-term trend line. But really, what's got me is this deterioration in relative strength. As the 10-year yield has fallen and faded, we've talked about the fade from the 2% level, and it continues to weaken in a flight to safety. Well, falling yields are a headwind to the bank stocks, and we're seeing that here as KBE is breaking down on a relative basis. Remember, we want relative strength. We always advocate the importance of relative strength. Now we've started to break down neutral power gauge ETF rating for KBE. Money flow, call it mixed of late, getting towards an oversold position, but it's hard for me to get excited here with rates falling the way they're falling and now that decline in relative strength. So I think you really need to be careful with the banks. I think you need to be selective with your ideas and opportunities, and I think you really need to be paying attention to what yields are doing. Let's take a look at what's trending now. Yesterday's S&P 500 gainers and losers, our movers and shakers. L Brands up nearly 13% on reports of possible strategic alternatives and also some commentary that the CEO may step down. That sent that stock higher by nearly 13%. GE reported earnings yesterday, stock higher by 10%, has a very bullish rating here at Chaikin Analytics. Progressive PGR, part of the insurance group, up 5.7% after announcing December results. Also a very bullish rating here at Chaikin Analytics. AVY up 5.4% following their earnings announcement. And DOW up 5%, 5.32%. as they announced earnings, but I will note that they did catch a downgrade here today. On the loser side of the board, Xilinx, one of the weak semiconductor stocks. Semis have been strong, but Xilinx has not joined that party. Down 10.7% following their earnings and their guidance. Hess earnings sent that stock lower by nearly 7%, but I will note that it did catch an upgrade here today. Keys, no real news there. Stock lower by 6.34%. Anthem reported earnings, stock lower by 6%, and AMD's guidance missed. That took 6% out of that stock. We'll note, though, still want to focus on the semis today as Lam Research reported results last night that beat estimates. That stock was trading higher in the pre-market. Let's dive into the charts now. We're back. It's Thursday. We're looking at market breadth, and we did see some breadth metrics weaken over the course of the past week as the markets become choppy here. The percentage of stocks above their 200-day moving average is down. Remember, we were up over 80. Now we're down in the mid 70s, and we've broken below this breakout level. So from a long-term perspective, still a healthy majority of stocks in long-term uptrends, but definitely some deterioration there. On the intermediate term, same story, right? 56% of stocks in the S&P 500 currently above their 50-day moving averages, and that is a deterioration, and it's now below that 60% mark. So what we'll be watching for is further deterioration here as a sign that the market may take out the support levels that we've been highlighting. Not seeing enough of it yet to get me to alter the view. Take a look at the AD line, the advanced decline line at the bottom of the list, tracking the market, but still in a healthy uptrend. But we are going to be watching, right? Short-term metrics start to break down, starts to impact the long-term metrics. We want to be aware of it and try to catch it as early as possible. Now, should early morning weakness hold throughout the day, I would expect these metrics to deteriorate further, which just gets to my point. We want to be selective. We want to watch the S&P 500 and see if it holds that support level, right? There's no rule that says you have to trade, right? There's some near-term uncertainty in the market here. I think it's important to manage your risk, right? Honor your stops and your risk management discipline. And continue to watch for these signs under the surface to see if they deteriorate further. That's what we're looking at as it relates to the breadth metrics in the marketplace. Now, the virus fears are also impacting global markets. Here's the ACWX, the iShares MSCI ACWI XUS ETF. After that breakout, we've now pulled back to test this first support within this zone between $46.50 and $48. We've broken a near-term uptrend line for the RSI, still holding above the 200-day moving average and trying to maintain a stance within bullish ranges from a momentum perspective. But similar to the S&P 500, we are now testing an important support zone. So how we react to this test of the support zone is going to be really important for determining the likely trend and path of the market going forward. Now, what I will say is that ACWX has begun to break down relative to the S&P 500. So as markets have turned choppy and slightly weaker here in the near term, the global markets are feeling the impact of that more so than the U.S. as ACWX breaks down, right, breaking through this little support zone that we started to build in the fourth quarter of last year and is now starting to underperform further against their U.S. counterparts. So just something to keep in mind if you are running a globally diversified portfolio. Finally, we've had a pullback in software and services, but it has been leadership. Take a look. We have a breakout in the XSW above the 200-day moving average. Now we're consolidating. RSI so far is holding bullish ranges after becoming overbought. And on a relative basis, we've broken this near-term downtrend line and are working higher. So if you are looking for the areas of the market, I think it's important when the market comes under pressure to look for the areas of the market that are holding up on a relative basis, because those are your likely leaders once the market does stabilize, and software certainly fits that bill. So keep an eye on the software group. That's going to wrap us up for today. Head over to chaikinanalytics.com/test drive, where you can sign up for a free 14-day trial to Chaikin Analytics. I'll be back here tomorrow.